Hey, this is Finnen Chatham Advantage Tutoring, and it's my job to get you past this Series 7 exam. So now I'm doing an exam. A Series 7 exam. I don't know how many questions. It's either 95 or 100. I don't remember. I wrote them and I never numbered them, so you'll have to deal with that. But these are great questions. They're really going to give you a good vibe that feels like the real exam. When I started doing these, when I first did these and nobody had done these before, I always said, I like these. Like, I like doing them. And what you do is you see the question, you press pause. Then you answer yourself, and then you see how you do against me. And I want you to put in the comments whether you beat me or not. And anything on there you disagree with me, because I made them up. I could be wrong. I'm not going to be wrong. But if I'm wrong and you think I'm wrong, disagree, throw it in the comments. Also, if you like what I'm doing, share the shit to people and like and subscribe and put the little notification on. So when I do more stupid rhyming videos and all that, we'll check it out. Also, don't forget, every Tuesday night at 8 p.m. Eastern, we do a live Q&A. Ask me anything on any of the Series 7, SIE, 6 exams, and then NASA exams on Thursday. So you will never hear on the live something you don't want to hear other than my cursing. Okay, let's get into it. So I'll try to talk through them as I go so you hear my thought process a little bit. Doesn't always work. Sometimes it does. Sometimes it doesn't. Okay, so first, foreign exchange rates are set by which of the following markets? Let's pause. So primary market, third market, interbank, or equity. Okay. So I'm like maybe I don't know this one, right? So I don't even know what it is. So what I'm going to do is I'm going to say, okay, I'm going to knock out shit that I know isn't right. So primary market is when they issue new shares. So that can't be it. Third market is where listed stocks trade over the counter, like the CQS or third market. And equity market doesn't mean anything. So this is interbank. This is the interbank market, is where the exchange rates are set between all the different currencies and the thing. So the answer is C as in Charlie, C as in cookie. Okay, here we go. Which of the following best describes a tombstone? Okay. Used to solicit transactions for a public offering, sent to prospective investors. C, provides details regarding new issues. D, an announcement of an offering and registration. So I'm actually going to do this. I'll read it out because I want to do this on the podcast too, so they can listen in. And whatever, we'll figure it out. So which of the following best describes a tombstone? A, used to solicit transactions for a public offering. B, sent to prospective investors. C, provides details regarding new issues. And D, announcement of an offering and registration. A tombstone is an ad in a newspaper. It looks like a tombstone, right? So that's what it looks like, an old tombstone, right? So it has like, this is what we're doing. Maybe it has a range. It has how many shares we're doing. Lists all the underwriters. It's not sent out to people because it's in a newspaper. So it can't be B. And it does give details on new issues, but that's not really what it is. It's not a lot of details. It's like, here's the shares. This is our company. And there's underwriters. Not a lot of details. So C is out. So now either is it A or D. Now, technically, here's the thing. It probably does do A, but that's not what it's for, because you can't solicit, right? Solicit can only be done through a prospectus for a new issue, so I'm going to throw that out. The answer is D. It's an announcement of an offering in registration. So we file the S1 registration statement, right? And then what happens? We go out and it does a 20-day review. During that 20-day review and after, we publish the tombstone in the newspaper. And that just says, hey, everyone, this is a new issue. It's in registration. Here are the underwriters. Here's the money. And here's the company. If you want to buy it, reach out to us. It's not an offer for sale. Boom. Interest income in a custodian account is reported on whose tax return? A, the custodians. B, the minors. C, the parents. D, the grantors. Again, interest income in a custodian account is reported on whose tax return? I think that's grammatically incorrect, but it is what it is. The custodian, the minors, the parents, the grantors. So remember, when you open it up, account, custodian account, the trustee manages it, but it's all on the minor. They pay taxes. It's their social security number, everything. So the answer is B, as in bullshit. Okay, good. Bullshit that the kid has to pay taxes. Okay, which of the following new issues of a U.S. government securities would be considered a money market security? Money market's a year or less, right? Okay. A, T-bills. B, T-note. C, T-bond. D, T-strip. Funny. T-bill, T-note, T-bond, T-strip. So T-bills are under a year. T-notes are 2 to 10. C, T-bonds are 10 to 30 or 0 to 30. And strips are up to 30. So money markets are a year or less. It has to be A as an apple, T-bill. Good. How are U.S. Treasury securities issued? Okay. Auction, negotiated underwriting, open market transactions, or syndicates. Okay. So Ginnie Mae's and stuff are done through like negotiated selling groups, but all treasuries are done through an auction. So it's A as an apple. Treasury securities are done in an auction. They do it like every week, or every quarter, every month, whatever it is, depending on how big it is. Meaning, if it's T-bills, I think it's every week. I think if it's T-notes, it's every month. And I think it's T-bonds every quarter. Don't hold me to that. Look it up. You can figure it out. All of the following statements regarding variable annuities are true except. A, professionally managed. B, insured against losses. C, death benefits. D, right to vote on changes in objectives. So again, we have all the following about annuities are true except. So we want to know, is it professionally managed? I think so. Are there death benefits? Yes. If you die before you annuitize, yes, you have that. And D, right to vote on changes. So if you have a mutual fund or something in the sub account, you get to vote if they change it. So the answer is B, insured against losses, because the whole point of a variable annuity is that it's a security because you have a reward, plus you also have risk. You can lose your money. So the answer is B as in boy. Okay, Roman numeral, which they don't usually have in the test, but I was lazy. Which two of the following choices are true regarding telephone solicitations? 1, calls are only allowed between the hours of 8 a.m. to 10 p.m. 2, firm must maintain written procedures regarding telephone solicitations. 3, the firm must maintain a do not call list. And 4, the representative must maintain a do not call list. So if you're doing a prospect on the podcast, just pick which ones you want. So I'm going to go with, okay, 1 is out because you can call between 8 and 9. So 1 is out. 2, firm must maintain written procedures. Obviously, that's always an answer. So 2 is one of them. And then the firm must maintain a do not call list, not the rep. So the rep doesn't maintain a do not call list. The firm does. So the answer is dose 2 and 3. Written procedures and do not call list held by the firm. I love it, guys. Okay. If a customer wishes to tender a brokered CD, broker, I should change it to brokered, right? I don't get brokered. Okay, there. CD prior to maturity, that RR should inform the client that the customer should expect a penalty. That's A. B, customer will receive principal plus accrued interest. C, the customer will receive market price plus accrued interest. D, the CD may not be sold prior to maturity. So I'm not sure about this one. I'm struggling on this one. Okay, but here. So if it's a brokered CD, it means I can kind of get rid of it. So I shouldn't expect a penalty. So A and D are gone. So it has to be either B or C. Now, the whole point of a brokered CD is that if rates go up, you're going to sell back to the bank, but you're going to get less than principal, because the principal is the par value in a way. So if you sell it early, you're going to get less than you expected, plus accrued interest, less or more, depending on the rates. So the answer has to be C as in Charlie. The customer will receive the market price plus any accrued interest. That has to be the answer. Okay, onward. On an initial transaction in a margin account, which of the following will cover a short call? Okay, which will cover a short call? A, cash. B, short stock. C, long put on the same stock as a lower price. And D, long call on the same stock as a lower strike price. So let's think about this. So if I'm short a call, the risk is like, say remember, press pause, it doesn't fuck you up. So if I sell a 50 call, doesn't matter. The premium doesn't matter. So I sell a 50 call. If the stock goes up to like 90, it will be exercised. I will have to buy the stock at 90 to sell it to you at 50, so I lose money. So what can I do to protect myself on that? Cash doesn't help me. Short stock doesn't help me. Now remember, I have to go buy the stock at a higher price. So maybe if I bought a call at the same or lower strike price, I'm locking it in. So maybe if I buy a 45 call, okay, then even if the stock goes to 90, I get to buy it at 45 instead of 90. So I make a little bit of money. So that's what they mean by cover. So I can either buy the stock. Here's the thing. So I can buy a right. Let's throw rights out. I can buy a warrant. I can buy a call. I can buy convertibles. I can buy stock. All of those things are like buying stock, so that even if the stock goes to 90, I'm not worried about it because I have the ability to buy it lower. Okay. So the answer is D as in David. Okay. Which of the following best describes a stock that moves with the market? Okay. A, income stock, maybe. B, special situation. That's like mergers and takeovers and distressed and bankruptcies and regulatory risk stuff. C, defensive. That's like this pharmaceuticals, anti-cyclical. And D, blue chip. Those are the big ass companies. So the answer has to be D as in David, because an income stock, maybe, but they're kind of like flat because they pay income like utilities and stuff. They're not going to move as much unless there's crazy tariffs and oil drops or goes up. Special situation is based on the situation. Defensive is like counterintuitive, counter-cyclical. And D is blue chip. They go with the market. I love it. D as in David. A golf pro at a register reps country club. My grammar sucks. Just deal with it. Wants to refer prospective clients to the RR in exchange for a small fee. This would be permitted if, okay, A, with the firm's consent in writing. B, if the RR received no more than 10% of the total commissions from the clients. C, if the RR disclosed it to a principal, which is usually a right answer. And D, under no circumstances. So here's the deal. You're taking this test so you can get goddamn commissions. You think it's okay to give a golf pro commissions? No. The answer is no. Unless that golf pro is registered with a broker-dealer, can't pay him shit. So the answer is a D, D, under no circumstances. Good. My grade point average. Okay. The record date for a cash dividend is Wednesday, July 5th. A client buying the stock would receive the dividend in all the following circumstances except A, regular way trade on June 28th. B, regular way trade on July 3rd. C, cash trade on July 3rd. And a cash trade on July 6th. Okay. So we have to settle by Wednesday, July 5th. So we know that the 4th of July is a holiday. We should know that. Okay. The only people that may not know that is if you don't live in the US or you just live in Canada or Mexico and you hate us right now. So let's say, regular way trade on Wednesday, the 28th. I settled the next day. Totally cool. I settled before the 5th. Regular way trade on Monday, July 3rd. I buy it on the 3rd. I settle on the 5th because it's one day, not including holidays. So that I settle on the 5th. I'm okay. So A and B, I'm getting a dividend. If I buy a cash trade on the 3rd, that means I settle the same day. Boom, I get it. So A, B, and C are all good. I am going to get the dividend for A, B, and C. So here's the deal. Cash trade on July 6th. So think about it. If I buy the stock on a cash trade on Thursday, it's after the record date. I'm too fucking late. The record date was the 5th. You had to buy it settle by the 5th. There is no possible way, unless you're Albert Einstein, that you can go backwards, that you could buy it on Thursday and settle on Wednesday. So it doesn't work. So the answer is D as in David. You will not get the dividend. If you buy cash or regular way, it doesn't matter. A bond which was initially offered at a premium and shortly thereafter called at par would most likely benefit, okay, A, the issuer, B, the bondholder, C, the underwriter, D, the broker. So always remember, whenever they call a bond, the issuer does it because it's good for them. They're not going to do it if it's good for you. So they're going to call it when it's good for them. So when rates drop, the issuer is going to call it and you're going to get screwed a little bit. So it's always good for the issuer. Now, call protection is good for the bondholder. Call features are good for the issuer. And both of those, the call protection is best when rates are dropping because that's when issuers will buy them. And call features are great when the rates are dropping because people are going to call them off. Okay, so remember, calls are always good for the issuer, not the bond. If yields on short-term bonds are lower than yields on long-term, so the short-term yields are lower than the yields on long-term, the yield curve is it inverted? Is it normal? Is it flat? Or is it cannot be determined? Very rarely, I don't think ever, will cannot be determined ever be a choice. So let's throw out D. I'm not going to do that. Is it inverted, normal, or flat? Well, flat means they're the same. Inverted means the short-term yields are higher than the long-term. So then it has to be a normal curve because the short-term yields are going to be lower than the long. That's a normal situation. Wunderbar. So the answer is B as in boy, normal. The opinion as to the federal tax exempt status of muni bond is provided by who? Okay. The IRS, a bond attorney, underwriters counsel, SEC. So again, the opinion. Remember, the IRS doesn't have opinions. They just come and take your damn money. So it's not A. It's not A, the IRS. It's not the SEC. And it's not the underwriters counsel because that's a lawyer for the underwriter. This is going to be the bond attorney. This is bond counsel. They did this on purpose to try to trick you. Bond counsel, they give you a non-qualified opinion if there's no issues, like it's tax-free and all that shit. I love it. So the answer is B as in boy. Yes, I didn't say. Upon notification of a client's death, all the following actions, see, I do that. See, you guys are my guinea pigs. All the following actions must be taken except cancel all open orders. B, mark the account deceased. Close out short positions. Wait for the executor administrator, the executrix administrator for the instructions. Okay. So if I find out a client dies, yes, I cancel all the orders. I 100% do that. I mark the account, I freeze it and mark it as deceased once I cancel the orders. You have to do it in that order because if you freeze it, marking it deceased, then you can't cancel orders. Who knows? They probably have a mechanism that automatically cancels them anyway. wait for the administrative instructions. Yes, you do not close out the short positions. It sounds awesome, but you don't do trades. So once a person dies, even if you have power of attorney, it ends. You can't do anything. Okay, so keep that in mind. If you don't close out their positions, whatever they have when they die, and then the executor, whoever gets in charge of it, will decide what they do with those positions, not you. So the answer is C as in Charlie. You do not close out short positions. Which of the following documentation is required to open a margin account for a corporation? A, list of corporate officers. B, list of board of directors. C, resolution. D, most recent audited income statement. Okay. So when you open a account, you have to have to open the account in general for a corporation, you need a resolution. And then to do the margin or options, you need the charter, which allows them to do it. They're not giving you charter. So the bottom line, you have to look outside the realm a little bit. The corporate resolution is what you need to open the account, because you need to open an account in general. To open an account, you need the resolution, first of all. To open a margin, you need charter, but they didn't give you that. And that's the thing a lot of people go, wait, there's a question to go, I would never do that. Okay, that's not the deal here. The deal is you deal with the situation they gave you. Okay, so if they give you a situation, you need to deal with that scenario that they gave you. So they didn't give you a charter, so you have to take the resolution. Okay, I love it. See if we can fit them all in here. So that's what she said. Okay, now, a customer seeking to purchase a security that combines the characteristics of a stock and a bond. The customer's RR suggests that she purchase a preferred stock. Which of the following characteristics of preferred stock should the RR discuss with the customer? A, preferred stock gives no voting rights to its holders. B, preferred stock is not permitted to be called by the issuer. C, preferred stock is not permitted to be converted into common stock. D, rights to dividends are subordinate to common. Okay, so start with D. Yes, dividends are ahead of common, so D's out. C, you can obviously have convertible preferred. I agree. And then you can have callable preferred. So for B, so the answer is A, preferred stock has no voting rights. Boom. And they don't get stock splits or stock dividends or any of that shit. They only get cash dividends and they get paid before common. That's why they're called preferred. Okay. A customer wants to invest only in federally tax-exempt securities. Which of the following investments provides diversification within his portfolio? A, so I only want to invest in federally tax-exempt securities. A, treasury notes at periodic intervals. B, treasury bonds of several maturities. C, revenue bonds of different sectors of the market. D, range from a specific geographical area. So I'm on diversification and tax-free. So let's go through this. Let's see if we can knock two out. A and B are gone because treasury, remember, entities tax themselves. So if you buy treasuries, you pay federal tax. So A and B are gone. The answer is C and D. Okay. So it's either C or D. Now let's go down to this. So revenue is one geographic area. That doesn't help me at all. So the answer has to be C as in Charlie. Revenue bonds from different sectors of the market. C as in Charlie. How long does a former client have to initiate a claim that will eventually go to arbitration? Okay. Arbitration. Okay. Like anticipation. Arbitration. Okay. 6 years from the date the account was opened. 2 years from the misconduct was discovered. C, 6 years from the date of the alleged event, because you're innocent of proven guilty or occurrence. D, 3 years from the date where the account closed. Okay, so arbitration, you have 6 years from when it happens. This is a memorization. Boom. So when it happened, when you think it happened, you have 6 years from then to do it. It's not 6 years from the account was open, because that would suck. Because then every rep who came after you would just wait 7 years and start screwing you. Not 2 years, and it's definitely 6 years. Okay. And remember, statute of limitations is another word for this. So statute of limitations is how long you have to actually go after someone. Now, if you take too long, then you waive that right. You lose that right. Okay. Under what market condition is the bank most likely to call a jumbo CD early? Interest rates have gone up. CD's principal is depreciated. Interest rates have declined. The bank needs more capital. Okay, so let's throw them out. Buying a bond, calling the bond, okay? Calling a CD means you're going to spend money. So D is out. If we need more capital, that's not going to help me. A, interest rates will rise. No, we call when rates drop. And then A is out. B, the principal won't diminish. Okay. So the answer is C. When rates drop, banks and issuers call their preferred bonds and CDs. Which of the following is true of a UIT, a unit investment trust? A, it actively trades its portfolio to beat the market. It reinvests dividends into additional securities. C, it has a fixed portfolio and stated expiration date. And D, it issues shares that trade at NAV throughout the day. Okay. Let's do this. Okay, it doesn't actively trade because it's a fixed portfolio, so A is out. It does not buy additional securities because that's the thing about a UAT, it's fixed portfolio. So if the preferreds get matured or they disappear or they're called, they won't replace them. So B is out. D, it issues shares that trade at NAV. No, they trade at NAV, but not throughout the day. So the answer is C. It has a fixed portfolio and pretty much has a stated expiration date because it mostly buys bonds. And once the bonds are done, the bonds are done. Okay. So the answer is C, as in Chuck. When can a company force a conversion of its convertible bonds? So it's really when should they? So when can they force a conversion of the convertible bonds? That's when they issue a call and you'll be stupid not to convert it, so you convert. After receiving 2/3 shareholder vote via proxy? No. B, when the bond market value is below par? Maybe, maybe not. When the stock trades above the conversion price and the bond is callable? Maybe. And only through a formal tender offer a premium. Okay, so no. So the answer has to be when the stock trades above the conversion price, right? So when the stock is trading above parity. So, ooh, interesting. Hold on one second. Let me think about this. I got to not screw this one. So I don't love the wording, but look, A is out. B is out because it's not there. So a forced conversion is when they call it and it's stupid for you not to, so it's profitable for you to convert. So if you have a choice of selling it to me, the bond, the issuer, at 102, say, and you can convert it at 104, you're of course going to convert it. The D is out because it's only done through a formal tender offer. So the answer is C. I don't love the wording, but it is. So when a stock trades above the conversion price and the bond is callable, they will call the bond, say, hey, we're willing to buy the bond from you at like 103, but if you convert it, you get 105. If you convert it, better. So I'm not making you convert, but I'm making it so it's stupid not to convert. So the answer is C, is in Charlie. Which of the following statements is true about a security with a beta of greater than 1? It will always outperform the market in a down market. That's A. B is less volatile than the market. It is more volatile than the market. It guarantees a higher return on the market. So again, A is outperform always. B is less volatile. C is more volatile. And D, it guarantees a higher return. So we don't worry about the D because no higher return. So nobody wants a D. So D is out. It will outperform the market. It may outperform the market in an up market and do worse in a bad market because beta is a multiplier. So if you have a beta of 1, you move with the market. If you have a beta of 2, you move twice as much as the market. So in other words, if the market goes up 10%, you're going to go up 20, which is better. But if the market goes down 10%, you're going to go down 20%, which is worse. So you do better in a good market, worse in a bad. But if you have a beta of less than 1, then you're going to do worse in a good market because you won't go up as much, but better in a bad market. So the answer is, and remember, 1 means you move with the market. 1.5 means more. 2 means more. Anything over 1 means you're moving more than the market in the same direction. So the answer is C, as in cavalcade of stars. A customer places a sell stop limit order with a GTC. A lot of instructions. Sounds like a Starbucks drink. Place a sell stop order with a little side of GTC. Based on the Slob's Bliss mnemonic, which of the following best describes how this order works? The order activates above the market, it becomes a market order. Well, maybe. The order triggers at the stop price, it becomes a limit order. The order remains active for 1 trading session only. The order must manually re-enter each day. Okay. GTC means it stays there until you cancel it within reason. So C and D are out because they're both saying 1. So it's either A or B. So a sell stop, remember, sell stops are below the market. So a sell stop triggers when it gets down to the price. So the answer has to be B because it's not above. And then let's figure it out. It's a sell stop limit. A regular sell stop, when it trades at the trigger, it will become a market order. A sell stop limit becomes a limit order, and boom, you're on to the next question. The answer is B. We're about a third of the way. Which of the following real estate programs is generally considered the riskiest? Office buildings, A. B, raw land. C, government-assisted housing. D, income-producing residence. Okay, so this should be somewhat easy. So C, government-assisted housing. You have the government backing you. That's okay. Out. D, income-producing residence. That's not so bad. A, office building or raw land. So B is raw land, which means you're buying a lot with nothing on it. That's high risk, high reward. because you have to build something and then hope somebody wants to buy it. It's not the old, if you build it, they will come. You don't know. So raw land is the riskiest. Which of the following orders we place below the current market price? So this is easy. This should be an easy one, right? So just remember slobs, which you just did, or bliss. So what's below the market? Buy limits and sell stop. So let's find it. Do I see buy limit here? Oh, yeah. And I see sell stop. Okay. Now, interesting. So this is a tough one because literally you have both buy limits and sell stops are both below, right? So here's a little nuanced thing. Technically, you can put a buy limit at the current market price. Sell stops, you would not do that. So if I had to choose one, I would always choose a sell stop because they must be below. They can't, I mean, they can be less sell, but that's fucking dumb. So buy limit, you can put, right, it's trading at 42. I want to buy it at 42, not higher. I can place it at it. So see how there's two, sometimes you have to think outside the box a little bit. So I'm saying if I have to choose between these two, I would choose a sell stop because that must be placed below the market, where a buy limit can be at or below. Tricky question. A client believes an inverted yield curve signals an upcoming recession. Which of the following bond investments is most appropriate given this outlook? An inverted yield curve, we have an upcoming recession. Okay. That means the yields are going to start dropping. Do I short-term corporate bond, long-term zero coupon? Interesting. Let's see. So I would say that's a tough one. So short-term I'm going to throw out, and I'll throw out the intermediate term. So I got B or D. So I believe there's going to be a recession. And an inverted yield curve usually means the shorter terms have higher yields, but that's not going to stay that way, right? So what's going to happen is eventually the long-term yields are going to start dropping, and the high, I would say this is going to be the answer, because if the rates start dropping, that means rates are going to start dropping because of recession. That means rates drop, that bonds go up in price, and the long term is going to go up the most. I get the zero coupon, and I got to think about that for a second. But the thing is, it won't go above par. This one could. So there's a limit how much this can go because it's more volatile. But I do think this is still better because it can actually go above par. There's really not a limit how much it can make. So I know I say this, but this is something that I would kind of mark for review because I'm not 100% sure. Because understand, here's my issue with this. I'm mentioning an inverted yield curve, which means that the short-term yields might be higher and they won't move as much because of the duration. And I'm not saying that I want to maximize stuff. So I'm torn on this. I'm still leaning on this, but I could justify this. If anyone can come up with an explanation why this is better for me, please leave it in the comments. I don't know what number it is, but just if you do the inverted yield curve question, I'll know what you're talking about. I like this a lot, but again, I'm not sure because I can understand this because they use the word inverted yield curve, which means a short term is better than the long term. I like this, but again, so I don't deal with retail. So I'm okay with A or D, but you guys let me know what you think. A young couple in a low income, I'm going to add one to the end to make up for that. A young couple in a low income tax bracket wishing to invest long term for their infant child's college education. This is a no brainer, but I'm going to A, T-bills, B, T-notes, C, T-strips, D, T-bonds. Whenever you see college savings, you lean towards strips every time. Here's another reason why. Remember, 42% of people, households, do not pay income tax. They don't pay any federal tax. They pay state maybe and maybe some other stuff. But for the most part, they don't pay federal income tax. So the fact that the T-strip, if you had to accrete it every year, because OIDs you must accrete, it won't matter to 42% of them, especially low income, because they don't have to pay taxes on it. They accrete, but it's not a tax liability for them. So I'm going to go with strips every time. Now, if they said well-to-do and risk-taking, maybe you do a growth fund, that's not a choice. You go with the lady that brought you. Okay. A customer purchases 10K of inverse ETFs. If the underlying drops 10% and rises 5%, let's do this. These are easy. So I start with 10K. Now, the market went down 10, so it means I'm going to go up 10%. What's 10% of a 10 grand? That's up 1,000. I'm going to go up 1,000. I'm now at 11K. We okay with that? Good. Whether you're like with me or not, I don't care. Then we go to the next day. Volatile day. It's like tariffs are in place. Then the market's going to go up 5%. So I'm going to go down 5%. So the market went up 5, I'm going to go down 5. I looked at that. I couldn't figure out what I wrote. Then down 5% from 11 grand. So I'm going to do 11,000 times 5%. 11 grand times 0.05 is 550. Minus subtract that from the 11 grand. I get 10,450. And there we go. So remember, it's an inverse. You got to pay attention to that shit. Okay. I'm going to do one more and then take a break because I got to go watch my son play lacrosse. I'll finish it tonight. A moderately experienced investor. By the way, again, it's C 10,450. A moderately experienced investor is interested in establishing a day trading account. What does RR have to inform the customer? Okay, A, day trader must receive approval for a portfolio margin. B, not appropriate for a limited resource or limited experience investor. C, can make a lot of money if the margin is in place. And D, day trading is an excellent way to supplement a portfolio. Remember, whenever it says, what should an RR say? It's some sort of downer like, ooh, that's not going to work. Okay. So that's not true. Day trader out. Can make a lot of money if margins place. Ooh, you can't say that shit. And day trading, excellent? No. So this is what it is. If you're not really experienced, don't do this. Look, when I ran the prop trading firm, I had 400 active traders. I mean, day traders with access to literally almost an unlimited level of resources. I had research. We had sales traders talking of all that shit. Okay. So they still, out of the 350, I bet you on any given day, 50 made money. That means 300 of them were losing money on a given day. And out of that 50, not a lot to make money on a consistent basis. Day trading, yes, some people make money on it, but it is a high risk, high reward, high risk endeavor. So if you're moderately invest, if you're limited research or not really a professional, I wouldn't do it. Okay, let's do one more. Over a long period of time, which would be the biggest risk to a AAA rated insured zero coupon? A, credit risk, B, reinvestment, C, liquidity, D, inflation. Okay, so AAA means no credit risk. We throw that out. B, reinvestment to zero. There's no reinvestment risk. C, liquidity. Remember, the shorter something is, the safer it is, the more liquid it is. So C is out. So the only answer is inflation. Again, highly rated bonds have low coupons. So they have a lot of inflation. That's it. So the answer is inflation. It was a good one. I'll do one more. Ooh, okay. An experienced investor informs his RR to sell 10 December 50 calls at 5 and buy 10 XYZ December 60 calls at 1. When XYZ is at 52 at expiration, what is the max loss? I could go through all the fucking math here, but I don't have to. Because I look at the, oh, wait, we sold 10, we bought 10. Let's do it. I'm going to do the math. So I'm going to sell deck 50 calls at 5. Then I'm going to buy deck 60 calls at 1. Okay. So the first thing I do is I net out the premium. So that's a 4. Subtract. Buy and sell, you subtract. Then I put 60 on top, 50 on the bottom, and then I do the break even. So what's the break even? The break even is going to be, since it's a call, you're going to add to the bottom. My break even is 54. Anyone who knows my options knows where I'm going with this. If you don't know it, please buy it. John, if you don't know this way and you like it, join the options membership for $20 a month. You get all this shit. Okay, so 54 is my break even. And since the larger premium is a sell of a call, which is bearish, I am bearish. So that means going down, I can make money from 54 to 50. So I can make $4 on the way down, and I could lose 6 on the way up because I can't cross the strike price. So 54 to 50, 54 to 60 is a $6 loss. Yeah. Okay. Now, boom. Okay. $6,000. Okay. Sounds good. I'm going to end on that one. I'll be back after the game. Well, that was just fun. I don't think you noticed I was gone, but I just did 2 or 3 questions and I forgot to share screen. So I had to come back and redo it. So here we go. A customer is interested in buying an oil and gas ETF with a total return of 27%, which is quite the return last year. The customer is concerned it would be difficult to liquidate. What should the RR inform? A, can only sell after a year. B, actively traded. C, early redemption fees. D, marketable but prior returns are not indicative of future returns. Okay, so we're going to throw out A and C because you can sell it anytime you want. You can sell it a minute after you buy it. and they don't have redemption fees, so it's not a thing. So it's either B or D. Now, B is a true statement, but it's not enough. Remember, I've always said this, whenever it says, what should an RR say? It's going to be some sort of slow your roll, slow down. It's not a yes, go for it thing. It's going to be some sort of disclosure. So that's what D is saying. And yes, marketable means it's liquid. But remember, we did 27% last year. Don't expect it to happen again. There's always some version of prior returns are not indicative of future returns. That's a true thing. So the answer is D, as in David. MFP, Municipal Finance Professional, signs a check drawn on a joint account and submits it to a municipal issuer as a donation. Issuer official. He has a 50% ownership of the account. What percentage of the contribution is attributable to the MFP? None, half the check, all the check are based on a verbal attestation from the MFP. So we have to go down with that. Now here's the deal. You can only give as an MFP $250 per election, or you then can't do negotiated offerings with that issuer if you have more than that for that issuer for 2 years. Nor can your firm, or if you go to a new firm. So the question is, did they violate? They're not asking you to violate. They're asking how you do it. So if me and my wife if I'm an MFP and me and my wife have a joint account and I sign it alone, the entire check is mine. So if I gave $400, I'm violating. However, if me and my wife both sign the check and we write a $400 check, $200 is coming from her, $200 from me, not a violation. So since this person signed it and didn't have both people sign it, the entire check counts. So if they gave $250 per election, they're fine. But if they gave $400, they're in violation and they're fucked. They have the scarlet letter for 2 years. Okay. Which of the following statements is true regarding the tax treatments of investing in a variable annuity? A, death benefit values paid to beneficiaries tax-free. B, when paid out, earnings are taxed at capital gains. C, when paid out, earnings are taxed at ordinary income. D, a withdrawal of earnings before 73 is subject to a 10% penalty. So I'm going through this. Remember, everything's ordinary income except for a buy and a sell, option expiration, and mutual fund distribution of a capital gain, not the regular distribution. So none of that is the case. So capital gains is out. And it's not going to be tax-free because the only things that come out really tax-free are Roth, Covered L, 529, and life insurance. Because if you die, they get paid tax-free. So A and B are out. So it's either C or D. Now, before 73 is not a problem, but as long as you're after 59 and a half, there's no penalty. 73 is when you have to start taking it out. So the answer obviously has to be C as in Charlie. When paid out, earnings are taxed at ordinary income because retirement accounts are taxed at ordinary income. If you can't remember why, think the IRS has been waiting 15, 20, 30 years to tax you. There's no way they're going to give you a tax break. And that is that. So C. A customer asks his RR how an account qualifies as a pattern day trading and whether there is a financial requirement to qualify. The RR should inform the customer that a pattern day trader is one who executes A, 3-day trades in a 4-day period and must maintain a minimum equity of 25 grand. B, 3 trades over a 10-day period must maintain a minimum equity of 20. C, 4-day trades in a 5-day period must maintain a minimum equity of 25 grand. And D, 4-day trades over a 10-day period and must maintain a minimum equity of 20 grand. Doesn't it feel good when you're reading it and you go, God, I don't know this, and then you see the answer just jumps out of you? So the answer is C as in Charlie, 4-day trades over a 5-day period, and then you get a minimum equity of 25 grand. So 4 round trips in a 5-day period. Let us see. That's it. The other ones don't make sense. Good. It's the middle of the day. I shouldn't be yawning. Okay. A customer buys 10 corporate bonds at 92 with $321 in accrued interest. What is a customer's cost basis in the bonds? A, 10 grand, B, 95.21, C, 9,200, D, 88.79. So now here's the thing. We bought it at 92. So anything we add to that is going to increase it. However, accrued interest doesn't count toward cost basis because you're just paying what you're going to get anyway. So there's no upside. You're not going to get hurt. So the answer is 9,200 because there are 3 things that don't affect cost basis. I love the power of 3s. Selling a cover call, dividends, and accrued interest do not affect cost basis. Okay. Okay, a customer sells 2 XYZ. October 50 calls it 2 and later closes the position at 5. What is the result for tax purposes? It sounds like a tax question. It is, but it's really a gain loss. A, 300 gain, B, 300 loss, C, 600 gain, D, 600 loss. So I always say, first of all, Whenever I see two answers and they're doubled, I have to make sure that I count. So remember, this is 2. So whatever number I come up with, probably got to fucking double it. Okay, so let's go with this. So I start with, I sold a, remember, always remember that these are just the products, right? So you sold something for 2 and you bought it back for 5. You can just reverse it. You bought it at 5 and sold it at 2. That since you sold something at 2 and bought it at 5, that's a 3 loss times 2 equals a $600 loss. That's D. So understand, whenever you see closes out, it's literally a buy sell. This could be widgets. You sold the widgets at 2, you bought them at 5. That's what it is. It's really just a $3 loss times 2, which is 600. A 10% muni bond originally offered at par has been marked down, which means they dropped the price. The change in yields is 50 basis points. The resulting yield to maturity will be which of the following amounts? Well, if the price goes down, the yield has to go up. So it can't go down to not A or B. It's going to be either C or D. And remember, 100 basis points is 1%. So 50 basis points is 0.5%. So if the yields change 50 basis points, it's going to be this, 0.5%. So the answer has to be D as in dog. Onward. The news media reports on a highly unusual and volatile trading activity in a particular stock. The exchange halts trading in the security and receives criticism for doing so on social media. A trading halt in the stock is permitted if A, customer mistakenly enters an extraordinarily large order. B, the price of the security moves 10% the previous day's close. I'm doing it fast because you guys can read it. C, market makers in the securities lose more than 30% in the value of their inventory. And D, it is necessary to protect the investors and public obtaining information from the subject company. Okay, so we're getting into that. Now, you read this and you go, okay, what the fuck do they mean? So you're going to go into it. This is what happens. Stock goes crazy. Like in the middle of the day, the volatility goes up and down. There's no news. They halt the stock. They call the company and say, what the hell is going on? And the company comes back and goes, hey, we have nothing, or we have rumors of a takeover, blah, blah, blah. So the answer is going to be D. They do it to protect the public from getting information and using it to rip off the insider trade. So it's not this. This would be erroneous trade. It's not B, because that would be for like, if the stock drops 10% from the previous night's close, they prevent you from short selling but not trading it. And market makers lose money. That's their fucking problem. Okay, here we go. Under MSBR rules, how long is a broker-dealer required to retain a written customer complaint regarding a muni bond transaction? A, 2 years after closing, 3 years, B, 3 years after receipt of complaint, 4 years after account closing, 6 years after receipt of complaint. Here we go. So a complaint under FINRA rules is 4 years, under MSRB is 6. Made it easy that you don't have to remember closing or not. But it's from the date of the complaint, it's held for 6 years. MSRB is 6, FINRA is 4. F for 4. Good. Here we go. When the bid price is 48 and a customer asks her order to sell 100 shares at 50, the RR enters a good till cancel order to sell 100 shares at 50, good till cancel. 2 weeks later, she changes her mind. ABC trades at 47, and the customer tells the RR to just sell the stock at the best price possible. What does the RR do? A, reduce the current GTC order to 47. B, enter a new order to sell at the market. C, reduce the current GTC order to 47.50. Or D, cancel the GTC order, enter a new order to sell at the market. So remember, you cannot amend orders, okay? You cannot amend orders. So you have to go with A is out. You can't reduce it. You have to cancel, replace. Every time you change an order, it's cancel, replace, okay? You cancel this, put a new order. When I get orders, I buy 1,000 shares at 42, and they later go buy 1,000 shares at 42 and a quarter, cancels the original, okay? Enters new sell order at the market, that would work, but it leaves the GTC order out there, so that's no good. Again, you can't reduce the order, and they said market, so A and C are out because those are limit orders anyway. And the answer is D, cancel the GTC order and enter a new order to sell at the market because he didn't give you a price. Good. Okay. Here we go. A company pays a common stock dividend of $1 per share and a preferred stock dividend of 4. Don't care about the preferred. After paying the dividend on the preferred, the company's earnings per share are $5.50. What is a dividend payout ratio? It's always, and again, A, 10.5%, B, 18.2%, C, 54.5%, D, 90.9%. A lot of people add the common and the preferred together and then divide. to get to 90. That doesn't work. The dividend pay ratio is what we pay into the common. So it's $1 we're paying versus the earnings per share of 550. $1 minus 550 is 18.2%. And we're going. Now, this one almost got me because I didn't read it. And reading is fundamental, fuckers. Okay. An RR is opening an account for a retail customer who wants to purchase a muni bond. Under industry rules, which of the following individuals is qualified to approve the account opening account? A, GSP, General Securities Principal. B, Investment Advisor Rep. C, Muni Securities Representative. D, FinUp. FinUps can't do shit. They think they can, they can't. So D is out. We're throwing that way. So then I'm going, at first I'm looking at C, because I was tired. I'm 50 questions in. And I go, oh. And then I saw A. So I go A. So the answer is A because the General Securities Principal approves. Now, if that's a municipal securities principal, maybe I would have a problem with it. But it's opening an account in general, doesn't have to be a muni account. So it's going to be the General Securities Principal every way. But I was leaning toward this until I read that it was a rep because reps don't approve shit. Remember that. Okay, here we go. An index ETF has a 5% buffer and a 95% participant. What happens if the index drops 20%? This is a hard one because they talk about buffers. I've talked about buffers and barriers before. Buffers have a percentage. Barriers are better because they prevent you from losing. But here we go. So it has a 5% buffer and a 95% participation rate. So that means if they do this, okay, not a lot of them have them, but it is a thing. More it's an ELN and stuff. If it drops 5%, you don't have to worry about it. So you don't have to worry about the first 5% of losses. That's the deal with this, okay? So the first 5% of loss is not your problem. And then everything after that, you get 95% of that. So when the index drops 5, it goes down 20%. You're only going to go down 15 because the first 5 is taken care of. We cover that for you. And then you lose 15. 95% of participation rate means you're getting 95% of the gains or the losses. So you only get 95% of the loss. So you only lose 14.25%. There it is. Good stuff. I like it. Again, because 15 divided by 15 times 0.95 is 14.25%. So that's why I only lose 14.25. Onward. Okay. Sorry, I'm pausing so much because I'm coughing my brains out and my dog's just out to bark. You don't need to hear that shit. So how long must a tender offer remain in effect? A, 5 days. B, 10 days. C, 20 days. D, 30 days. This is literally a memorization thing. Tender offers are open for 20 days. They have to be open for at least 20 days. And if you amend it, it's another 10. That's it. So the answer is C as in Charlie, 20 days. A corporation is, another tender offer one. A corporation is making a tender offer to buy back its shares at $10 a share. The offer is contingent on at least 100,000 shares being tendered and a maximum of 1 million shares. Okay? Now, your client tenders 1,000 shares and the total tendered shares is 1.25 million. How much will your client receive? Let's get into this. Sorry, the coughing is goddamn killing me. So I get $0, $7,500, $8,000, or $10,000. Okay, so here's the deal on this. They're buying it back at $10 a share. We're no more than 1 million. We tender 1,000 shares. Means we're not going to get. What they do is if it oversubscribes, which is what this is. If there's an oversubscription, they will give everyone a pro rata benefit. So you have to figure out how much. So if there's 1 million shares, willing to take. See, I'm dying. And remember, if I die, please, I'll post it. On my last breath, I'll hit post. Please share it. At least when I die virally. Okay, so now 1 million shares divided by, so you're going to do a pro rata. 1 million shares out of 1.25 tendered. 1 million divided by 1.25 is 0.8. So you're going to get 80% of your shares are going to be tendered out. What they'll accept, and you leave the rest. So 80% of 1,000 is 800 times $10 a share is $8,000. That's how much you're going to get $8,000 because remember they're pro-rating it. So 1 million divided by 1.25 million is 80%. 80% of your shares are going to get tendered and the other 200 kick back. But here's the thing. It doesn't really fucking matter because once they do a tender offer for $10 a share, the stock could be trading at like $9.99. So just sell the 200 shares at $9.99. It's probably better to just sell shares in the market at sell the shares at 9.99 instead of having to wait till the tender's over. So whatever, give up the penny. If an investor expects market interest rates to rise, which interest option strategy would you recommend? So if we think that the rates are going up. Remember, if you buy a call, you're expecting whatever it is to go up. If you buy a put, you're expecting to go down. So if I think rates are going up, remember, interest rate options are on the rates. So I'm expecting rates to go up. Buy interest rate calls. The answer is A, no other choice. Client has owned stock for 13 months and wants to lock in the gain but not pay taxes. What would you recommend? Sell calls, buy puts, liquidate the stock, which buy puts will wipe out a holding period, do nothing and wait till the next year. So we owned it for 13 months, lock in gain but not pay taxes. So since it's over 13 months, I don't have to worry about the losing my long-term status because I already have it. So I'll literally buy puts. I'll just buy puts because if I sell a call, I'll owe taxes at some point. If I liquidate the stock, I will owe taxes. If I do nothing and wait till next year to sell, I'm not locking in the gain, but I'm not paying taxes. So if I buy the put after a year, I don't ruin my holding period. Because remember, if you buy a put on the same days you buy the stock as a married put, or after 12 months in a day, you don't have a problem. It's a holding period. And if you don't understand that, you shouldn't be at this far in the test anyway. Okay, here's one that's tough, right? Because it's a memorization. Just remember that for a business development company, you have to have more than half. So the only one that it works is 50%. So 75 works, but it's not a must. So it's really 50.01. But let's go with 50%. 1% of the board has to be independent. That's just a memorization thing. That could even be a fake question. Who knows? A client's objective is growth and income. Which of the following preferred stocks would you recommend? Participating, cumulative, convertible, or regular? Well, once I say growth or capital appreciation, I'm going right to fucking convertible. And when in doubt, go with convertible, but that's what I'm going to go with. So when in doubt, go with convertible. If I see growth and income, I go with convertible. I love it. Love it. Which of the following formulas include the risk-free rate of return? Dividend discount model, PE, alpha, CAPM. Okay, so dividend discount model would not do that. That's looking at future value to get present value. Price earnings ratio is price over earnings. No alpha. No, it's beta. What you do about beta. So it has to be CAPM because the CAPM formula is the rate of return. The market return minus risk-free rate times the beta. So it has to be CAPM, baby. So again, the formula for CAPM is, there's two ways to do it. Market return times beta, that's your number, or market return minus risk-free return times beta, then you add the risk-free rate back in, which is usually the T-bill, and there you have your expected return. Here's a fun one. Who receives the surrender value of an annuity? Okay. A, beneficiary. D, be the insurer. That would be the insurance company. No. C, the annuitant. D, the broker. Okay. So it's not the broker and it's not the insurer. So it's got to be either beneficiary or annuitant. The beneficiary receives the money when the annuitant dies. So the surrender value is when you get up your annuity, whatever you left over after fees is the surrender value. That is the annuitant. So it's C as in Charlie, baby. Client found an old stock certificate in their closet and wants to sell the stock. What should the RR do? Advise the client to throw it away? No. Tell the client to mail it directly to the issuing company. Instruct the client to sell the stock immediately online. And I'd say have the client bring the certificate for further verification. It's got to be D. You're not going to mail it to the issuing company. They don't give a shit. You bring it in and you get further verification that it's real or not real. It could have been merged. Like you could have bought it and you get shares from a merger, stuff like that. Like my aunt in the 40s, she worked for pharmaceutical companies, and every time it kept getting taken over, bigger, ended up being Merck. So he ended up owning a lot of shares of Merck. Did I get any of it? No fucking way. But it was there. So bring the certificates in. Which of the following requires a pre-approval from compliance before being posted on a register up social media page? A birthday message, a link to an article about financial literacy, a list of available investments at the firm, a photo of the RR's office holiday party. I gotta think that it's gonna be, gotta be C. It's gotta be C, because this is just independent and it's not specific. This would be correspondence if anything else. And who the fuck cares? That's just a bunch of drunk people acting stupid. So it's gotta be C. It's gotta be C. Okay. A register rep inherits a book of business. The wife of the client calls and wants to know why her husband hasn't received his required RMD. What should the RRs do? Explain the RMD rules and provide the account balance. Ask to speak with the husband. Provide the RMD details since spouses have access. Set and written confirmation of the RMD to the wife. Obviously, you talk to the man because the man runs the roost. No, I'm totally fucking around because it's the client's account. Unless she's named on the account, you can't say anything. You say, I'll talk to the husband and explain to him. If it was the wife's account and the husband called, he would call to the wife. Don't come at me for that comment. I'm just fucking around. Client who owns an ETF wants to sell them and buy common stock to take advantage of a market upswing. What should the RR do? Execute the order immediately to capitalize on the market momentum, provide information to the client about commissions and fees for these types of investments, discourage the client from selling ETFs, which are more diversified, tell the client that switching products is prohibited under firm policy. This is a tweaker because I'm like, do you discourage ETFs? But I think, wait a second, your job is not to stop them from anything. You let them know, you educate them, and then you let them go. So the answer has to be B, provide information about commissions and fees for the investments and let them know what they got. And then if you want to give them advice, that's fine. But if they want to do it, you got to do it. So the answer is B, as a grade I never got in high school. A married couple has a trust account in a non-community property estate. What happens to the cost basis when one spouse passes away? Only the deceased spouse cost basis stepped up. The entire cost basis stepped up. The surviving spouse received no step up in basis. The cost basis is reset to the original purchase price. This means a lot, okay? The words fucking matter. A married couple has a trust account in a non-community state. What happens to the cost basis when one spouse passes away? Remember, non-community and only one died. A, only the deceased spouse cost basis stepped up. B, the entire cost basis stepped up. C, the surviving spouse received no step up. And D, the cost basis reset to the original purchase price. And so it's a community property, then all of it will be stepped up. But since it's not community, only the deceased spouse cost basis stepped up because they're the only one that died. So the answer is A, as in a grade I definitely never saw in high school or college. What is a quarterly dividend of a 4% preferred stock with a par value of 20? This matters. So they give you everything you need to know. Now, let's do this, baby. Let's go. We're going to do to the tulips. You're going to do 20. My calculator's about to die. I got to fix that. Okay. What the fuck happened here? I got to go back to the basic. There we go. Basic. So I'm going to do 20 times 0.04% is 80 cents divided by 4, 20 cents. There it is. So I'm going to do, let's get this thing right so I can use the calculator still. Quarterly dividend of 4% on a par value of 20. So you do $20 times 4% to give an 80% annual. Then you just divide it by 4. That's your 20 cents. But make sure you look at par value. Don't fuck around with that shit. A customer is told, we sold you 100 shares at $5,000 net. What does that mean? The words matter here. A, the firm acted as an agent and charged a commission. B, the firm acted as a broker and charged the fee. C, the firm acted as a principal with no markup. The firm acted as a dealer with a markup. So first of all, we sell it to you net. We sold you. That means we sold it to you. The broker dealer did. So it's definitely not an agent. So it's not A or B. Okay? Can't be. So because that would be we bought for you, or we sold to you, or we not sold for you, not to you. So selling to you is that. Also, I always kind of believe if you hear the word net in the report, it kind of means principal. And net means total cost. Net means everything's covered. Okay. Now, okay. So the answer would be D as in David, because that's what, so that $5,000 net means you totally got it. You got it at $5,000. Okay. You bought it at $5,000, and that's your total cost, including your markup, marked out, which would be markup since you bought. A client just submitted, by the way, in case you're not sure, I said D as in David. A client just submitted a large trade to repurchase stock with the sales department. Your firm has established informational barriers, Chinese walls embedded in the firm's software. Who can trade the stock? Only employees in the sales department, no one at the firm, employees outside the sales department, over only principals. So since you have information barriers, okay, since you have information barriers, you're not going to worry about the other departments don't know what you're doing. So the answer is employees outside the sales department. Some firms say you can't do it, but once you have information barriers in there, what the sales department or risk arb does, whatever, if you're not in the department, none of that matters to you. So answer is C, people outside the sales department. Client, what is the benefit for a private company to enter into a reverse merger? Reduces the need for long-term debt, increases the voting control for existing shareholders, facilitates going public without the process of registration, allows a company to avoid all regulatory oversight. No, that D is not a fucking thing. So throw that out. So a reverse merger, and it will be on the test, obviously, like this. A reverse merger is when a private company buys an already trading small public company and then uses that to go public so they don't have to go through registration. So the answer is C as in Charlie, C as in cookie. That's good enough for me. So facilities going public without the process of registration is the answer. Reverse merger is absolutely fucking testable on the test. I have to keep making sure it's recording because I have to cough so much I stop it. A client wants to borrow from his 401k. What should the registrar tell him? Don't do it. Don't do it. Okay. A, he can borrow the full account balance. He can only take a portion in relation to his vesting. Loans are never allowed, and he can borrow up to 100% of his vested employer contribution. So I'm going to say he can only borrow, he can take a portion in relation to the vesting. I'm going to say that's the answer. Because you can't borrow the full balance. Loans are never allowed. That's not true. And you can't borrow 100% of the vested employer contributions. There's a portion you can. I will double check this to make sure I'm not. I just double checked and I am correct, Mundo, because they don't let you borrow all of it, the vested. Even if you're vested the whole thing, you can only borrow like 50, 60% of it. So yeah, it'll never be 100% of it. So the answer is B, a portion based on the vesting. And it's usually a portion of what's vested. Now, if you guys know what vesting is, it's what the douchebag vested everyone on Wall Street with. No, it's actually in Midtown now. Vesting is when the employer puts money in for you, how much of that is actually yours after the fact, right? So if they put in $5,000 a year for you matching, when you first get it, that's not your money to withdraw if you leave. But after 2, 3, 4, 5 years, over a little bit of percentage of the years, that money starts becoming yours, where if you leave, you can take it out. If you take it out early, it's a penalty, but it's still yours to take out. So remember, if whatever you put in is immediately vested, whatever the company puts in is vested over 3, 4, 5 years. A customer makes a purchase of $22,100 of Acme Income Fund in a margin account. The customer has to deposit. Oh, what a tricky question. That is $22,100. It's not $5,500. It's not $6,000. It's not $11,000. Since it's an income fund, that means it's a mutual fund. You can't buy on margin, so you got to pay the whole fucking thing. Awesome. Ooh, fun stuff. I'm going to read the beginning. You guys can read the answers. An 80-year-old customer with an existing individual account comes into a branch office and tells his rep that my son has been telling me that I need to give him power of attorney over my account because of my advanced age. And I want to keep him happy and keep him from putting me in a retirement home. But it was starting my mom and dad when I was younger. What should the rep do? A, the rep should give the customer power of attorney, form naming the son as attorney of the account, and have the customer sign the form. Eesh. B, represent should contact the son and get permission to have the customer sign power of attorney. Eesh. The rep should escalate the matter to the branch manager or compliance department of the firm. D, the rep should freeze the account until it can be determined that the customer is not mentally capacitated. Okay, no. The answer is C as in Charlie. This could be manipulation. You're not sure. So it's not your call. It's above your pay grade. Boom. Throw it up. Throw it up to the compliance or the supervisor and have them handle it. So the answer is C as in Charlie. Pretty much around my grade point average. A client age 35 is covered by a 401k plan at work and has also set up an IRA account. He has been contributing the maximum amount to each of these years. He lives frugally and has excess income for investment. He asks you, the representative, for an appropriate recommendation to add to his retirement savings. Which recommendation is appropriate? So, 401k at work, set up an IRA, has been contributing the maximum amount each of these years. Live frugally. I know where I'm going to go with this. So it's not A, 529. I don't think it's a KEO because that's self-employed. And a SEP IRA, no. This is the one time a variable annuity works. Because they're young, they can handle it. I would say B is variable annuity. This is one of the first times that I think a variable annuity works. It's always after you cap out your insurance and everything else. And if insurance is here, I tell them to do that, but they didn't do it. So I'm going to go with B, variable annuity, the VA. The dreaded VA. Client owns a total of 550 shares of mutual fund, purchase over a period of time for a total of $6,000, 6,200. If she redeems 250, 150 shares for 13 a share, what is her cost basis? So what I'm going to do here is I'm going to make sure my calculator works. I have to find out what the average is, and that's my cost basis based on 250. Now, 6215 divided by 550 gives me 11.3. That's my cost basis. It's per share. Doesn't fucking matter. It's per share. I will even double check the math. Hold on. Now remember, they're not asking Profit, they're asking cost base of what we paid. And mutual funds use average cost. So we're going to do this 6,200, 6,250 divided by 550 to get 1130. And that's your cost basis. Boom. Onward, onward, onward. A client owns 500 shares of a company with 5 million shares outstanding. The company will issue 1 million shares through a rights offering. If the client subscribes to the offering, how many shares will he now own? We got to do this. So they have 5 million shares. They issue. So he owns 500 shares. They have 5 million out there. That doesn't really matter yet. So they have 5 million out there. They issue another 1 million. So I'm going to do 1 million. How many we issued divided by 5 million, what they have outstanding originally. That gives me 20%. So I'm going to grow by 20% because that's what preemptive rights do. They give you the same ownership. So I'm going to do 500 times 0.2. That gives me an extra 100 shares times, add that to the 500. It gives me 600. They're not asking how many extra you get, you how many do you have after. So now you have 600 because you're bumped up by 20% because they issued 20% more. Bundaba. Okay. And investors, I love these questions. An investor's VA increases in value over the year by 1,100. At what rate is the gain taxed? Okay. So is it 0, 15, 25, or 28? So here's my thing. Whenever you see 0 in a number, see if it's a trick. Okay. So kind of like if you see convertible, you kind of lean towards it. Here's why. A variable annuity is a deferred product. So if an investor variable annuity increases by 1,100, you pay 0 taxes on it because it's deferred. You don't pay taxes until you withdraw it, not now. So the answer is not now, not know-how, not never. And actually, it's in when you withdraw it, I'll go with 0%. Okay. Retail communications for variable annuities may include all of the following except projected future returns, past performance, current yield, expense ratio. This one is a tough one because I'm really leaning between two. Retail communications for VAs may include all of the following except, okay, projected future returns, B, past performance, C, current yield, D, expense ratio. Okay, so here's my problem with this. I'm leaning toward one, but A, here's the problem. I'm leaning towards C, current yield. That you can show that A is the one we can't do because you can't predict or project. But the problem is, and I'm going to stick with A as my answer. And if you disagree with me, put it in the comments. Because I think you can do hypothetical assumptions, right? You can make hypotheticals, but you can't project future returns. You can say, oh, if it earns 9 and 0, we can show you this, but they can't have projected future returns. That's like saying, hey, this is what we think is going to happen. So I got to go with A. Like current yield, you'd have to put disclosure saying this is right now, it could change, blah, blah, blah. But I think you can put that in there. I do think you can do historical, 100% you can do historical. There's rules on that. But projected future returns, I think that sounds too guarantee-y, if you want to call about it. So I'm going to go with A is the answer on this one. A client wants to place trades after the regular market hours, which soon won't be a thing, using ECNs. What should the register rep advise a client? There is less liquidity and more price volatility. Okay. B, only accredited investors are permitted to trade after hours. Commission costs are significantly higher. You can't do that shit. And after hours is only institutional. No. So the answer is A, because there's less people trading, there's less liquidity, and there's going to be more volatility. When I was at the hedge fund, every time. Okay, hold on 1 second. Somebody just sent me a cool text. Not that you care, but I told this guy, a friend of mine who's a trainer, about there's nose strips you put on your nose that breathe right things, and they pull your nose out of it, which is gross. But, I mean, you put them on the side. You see football players do it and stuff. They literally opened up the pores. And it was like, not the pores, but my nose. I couldn't breathe. And he just texted me. He goes, this is a month ago. So I was waiting. He goes, breathe right strips fucking rule. Thank you. I love it. That's awesome. I fucking love when I always worry when I give advice because a lot of times it's shit. But I tried it out for a while and I just mention it. And I sleep with them. It's like, I can breathe again. Okay. I can breathe clearly now. The strips are on. Okay, here we go. Anyway, there's less liquidity and more volatility because there's not as many people. So the spreads are wider. That's what she said. And all that stuff. So the spreads are, see, it's getting late, so I'm getting punchy. So the spreads are wider. It's more volatile, and there's less people trading it. So A is the answer. XYZ declares a $1 dividend is payable on January 15th. On February 10th, the board of directors declared a dividend of $1 share for record holders on April 15th. The customer bought shares on March 21st, which is true of his cost basis. A, stock price plus dividends. B, sales proceeds plus dividends. No adjustment, stock price minus dividends. I'm going to go, because I have a rule. There are 3 things that don't affect cost basis. Cover calls, accrued interest, and yes, you guessed it, dividends. So there has to be no adjustment because your cost basis is your cost basis. Dividends don't change that. You look at this and think, oh my God, are we eligible for dividend? That's not the question. This is a classic example of read the fucking question. Read the answers before you start answering it, because you probably started doing it in your head. Oh, do I get the dividend? Blah, blah, blah. None of that shit fucking matters at all. Okay, why are there turtles on my TV? The common stock of a company at $84 a share, the PE ratio is 14-1. Earnings were $6 and the dividend was $3 after a 5-1 split. What is a new PE? 3-1, 5-1, 7-1, 4-1, 14-1. Here's the greatest thing in the world. Remember, stock splits and stock dividends do not affect PE ratio. Well, I call it. So what would happen with a 5-1 stock split? You guys can do this on your own, but I'm not going to do it because I'm too fucking lazy. You would divide 84 by 5. And then you divide the earnings by 5, and that will give you 1.2. And it's still 14-1. So even after the split, the price goes down and the earnings go down, but the ratio stays the same, so it's still 14-1. Oh, boom! There we go. In a period of stable interest rates, which of the following preferred issues of a corporation's price will fluctuate the most? Cumulative, non-cumulative, convertible, adjustable. Oy! It's got to be convertible because when you're in doubt, go convertible. But here's the reason: interest rates aren't moving. What moves prefer fixed incomes? Interest rates moving up and down. But what moves a convertible? The shitty stock that you own. The stock going up or down is what drives the price. So the answer is convertible. There we go. Because convertible turns into common stock, so it moves with the common stock. RR hosted a seminar investing at a local club, local restaurant. Want to display the schedule on the personal website of the RR. What is true? Permitted if the supervisor attends. Give me a drink, I'll go. As long as the schedule contains the address and telephone of the OSJ, Office of Supervisory Jurisdiction. C, prohibited. D, prohibited because the seminar can only be at a branch office. No, people do seminars all over the place. D is out. A is permitted. That has nothing to do with the supervisor intends. Because if you get permission, you get permission. B, as long as the schedule contains the address and telephone of the OSJ. No. It's C is prohibited, but not for what you think. It's because you can't put shit on your own website. The personal website of the RR, that's a no-no. Unless it says unless it said firm approved website, the answer is a no. So we go with no. Okay. So the answer is C is prohibited. If an index option is exercised, the settlement is delivery of each stock in the index, exchange of shares in the index for the monetary value, payment of the dollar amount of the index, the difference between the closing price and the exercise. So remember, index options are betting on like the VIX, on the S&P, the Russell. So there's no stock to be given because it's an index. So you get the in the money amount. So it's this. It's the in the money amount. What do I mean by that? I mean that if you buy a 2,500 call and the index closes at 2,510, you will receive $10 times 100. That's the in the money amount. $10, you receive $1,000. If it closes at 2,520, you get 20 times 100. It's that simple. You don't get the value of the index, you get the in the money amount. I love it. Okay. Okay, good question. Stock split of a corp impacts which? Well, we know it's not PE ratio, and it does. Retained earnings is what we don't pay in dividends. That has nothing to do with how many shares we have, so that's out. And working capital is current assets minus current liabilities, which has nothing to do with the price of the stock. So it has to be par value, which sounds crazy. Par value of common is like $1 or a penny or 10 cents, whatever it is. If they do a 2-for-1 split, say our par value is $1. It's just an accounting tool, right? The par value is $1, and we do a 2-for-1 stock split. The par value is now 50 cents. That's it. Boom. It's A. Okay. CFO of XYZ, an SEC reporting company that matters. Not on this question, but in general. Purchased 20,000 restricted shares 8 months ago, 900K outstanding, and the average weekly trading volume for the past 4 weeks is 3K a week. The CFO sold 2,000 shares so far. Under Rule 144, how many more shares can he sell? So remember, since he's a CFO, he's an officer, he has to follow first. Is it restricted? Yes, but you only have to hold it for 6 months or a year. So let's say 6 months because it's reporting. So we don't have to worry about that, okay? It's held outside the holding period, but now we want to sell it. Since he's a pod, partner, officer, director, a big ass shareholder, he has to follow the 144 rules. So the 144 is 1% of the outstanding, which is $9,000, which is 1% of 900K. And then the 4 week trading volume is 3K. So $9,000 is more than 3K. So we can sell 9. That's not a choice because he's already sold $2,000. You can sell another 7. Boom, $7,000. Because that's 7 plus 2 equals 9 usually. Which of the following activities will result in a decrease in NAV? Issuing of shares, redemption of shares, sales of depreciated shares, payment of cash dividends to shareholders of the fund. So there's really only 2 or 3 things that affect the NAV, and I'm going to go with the 2. If they distribute a dividend or the shares, the value of the assets go down. That's up or down. The only things that change the NAV, if they distribute a dividend, because you distribute it, it goes out, it's not in the fund anymore, or if the assets go up or down. So I'm going to go with D as in David, because when they pay out a dividend, the NAV goes down. Or if the assets go up or down. Good. Great job, guys. Okay. A customer owns a leveraged ETF, seeks a return of 200%, which means 2x, in case you didn't know, the major stock index, and is trading at $50 on day 1. What will the price of the ETF be if on day 2 the index rises 10 and loses 20 on day 3? So let's walk through this. It'll be the visual. So we start at $50, right? We start at 50. Oh, right? That work? I'm not screwing it up, right? Okay, good. Now, the first day the market went up 10%, so we're going to go up 20. 20% of 50 is 10, so we add 10. So now we're at 60. We're at $60. That's our new price. That's our set price. Now for the new day, we start at 60 because that's where we reset to. So $60. Now the market went down 20, so we're going to go down 40. 40% of 24, do it yourself, 60 times 0.4 is going to be minus $24. So we're at 36. You cannot, okay, 36. You cannot just go up 10, down 20, lose 10. You can't do it that way. It doesn't work. You have to do each. I'm sure there's some math brain that can do it, but don't bother. Just do it this way. It's quicker. Up 10%, we go 20. That's $10. We're at 60. We're down to 20%, which means I'm down 40, which is 24. We're now at 36. Pretty straightforward. Okay, onward. We're getting near the end. What is the buying power of the account? They own 100 shares of XYZ with a market value of 7. And then they own, let me clean that up a little bit. Nope, I don't do that. Okay, we're going to deal with it. Okay, now, owns 100 shares of PDW with a market value of $4,000. Why it's different? What's different? Oh, I got it. I put the oven there. With a debit balance of $5,000. So this is, we use my Mr. Desby. So our total market value, right, Mr. Desby, we're going to go down the Mr. Desby road. Let's make it a fun color. MRDESB, super easy. Okay. Now, what do we do first? My allergies are killing me, and I just rubbed my eye, and that's going to be real bad shit. Now, my first number is market value 7 plus 4 is $11,000 in most countries. Then my debit balance is $5,000. So my equity is 11 minus 5, what it's worth minus what I owe. That's going to give me $6K. So $6K is my equity. Now, what do we do now? I go, okay, I got to find the reg T because that's how I find SMA. SMA is always equity minus reg T. So my reg T is 5.5K. So $6,000 minus 5.5 is 500. Now that is just, 2.5 to stay consistent. That is just my SMA. Buying power is 2 times that. That's 1, which is really 1K 1,000. So remember, to get equity, you do market minus debit. To get SMA, you do equity minus the reg T. And it's the current reg T. So if this stock went to 12, it'd be 6. Went to 13, it'd be 6,500. It's always half the current market value. That's the SMA. And then buying power is always 2 times SMA. Wunderbar. Good stuff. Okay. A retired customer who lives on income from his investment is interested in investing in mortgage-backed securities and encourage which of the following risks if rates fall. The customer will have a greater return over principal. That's not a risk. The mortgage holder will default resulting in lost principal. Well, maybe, but let's not go with that. Properties will decline, meaning a lower market price. That's fair on that, but that's not the answer. Prepayment risk. So the answer is D. When you have a mortgage-backed security, pretty much the main risk is prepayment risk or extension risk. When rates drop, people refinance early. You get prepaid. You're out. And if the rates go up, they don't leave they stay in their house longer, and you have extension risk. So the answer is E, extension risk. Good. No, it's not extension risk. That's for if it goes up. If it goes down, it's prepayment risk. The answer is D, as in David. A customer owns 100 shares of ABC stock, which has appreciated. The customer wants to protect his gain. Which choice is suitable? Remember, stops protect, limits don't. But first of all, I'm long stock. I'm going to look. Do you see buy, put, or sell a call? I do not see either of those, so it is not a option question. So I'm going to throw out B and C, because when you're long stock, it's either buy, put, or sell a call, no other reason. So now, remember, stops protect, limits don't. So the answer has to be A, but let's walk through it just so you understand it. I'm getting nicer at the end because I'm near the end of the test. So say I buy 100, say I buy 100 at 50. And then it goes up to 70, because not something I've ever experienced, but that's fine. And I want to protect the gain. So I put a buy put below 70, fine, or I do a sell stop, sell 100 at 65 stop. So this way, if the stock starts dropping, which would be normal for me, and it goes to 65, it'll just sell at 65. And I'll make a profit of, hopefully, it'll trigger at 65, and then I'll sell it probably at 64.99 or somewhere around there, unless it's me, and I still make a $15 profit. That's what it is. So protect means you stops protect, limits don't. Okay, here we go. Customer's cash account is frozen because someone free rolled, which means they bought shares and sold them without paying for it. All are allowed during the 90 days in the account except, okay, sales of corporate bonds, okay, purchase of shares paid for in 3 days. C, transfer shares to margin account, withdrawal of 200 shares. Okay, freezing account literally doesn't mean shit other than that if you're going to buy something, you have to pay for it up front for 90 days. It's not a big deal, okay? So again, you free rolled, you didn't pay for your shares, they liquidate this shit, they pay back what you owe, and then for 90 days, you still can't do anything till you pay up front. So the answer has to be B, because you can sell your bonds, you can transfer shares, you can withdraw. You can't pay for shares after. You have to buy them. You have to pay for it up front. So the answer is B as in boy. That's a gimme question. Call protection in a bond issue is most protect. This is tricky. Call protection a bond issue is most benefit. A, the buyer. B, the underwriter. C, the issuer. D, the IRS. Fuck the IRS. It's going to be the buyer A, because call protection prevents the issuer from buying the bonds back for a certain number of years. So that protects the owner, the buyer of the bonds. Call features, the ability to call the bond protects the issuer because they're going to buy it back. I love it. So the answer is A as an apple. An investor in a 28% bracket is looking to purchase a muni bond with a 6% nominal yield trading at a 7 basis, would need a taxable equivalent of. So let's do this. So you would need a 7. You're going to do the 7 because that's what you're earning. 7 divided by 100 minus the tax bracket divided by 0.72 should give me 9.72. And there is the answer. Now, I think if I did the 6, that doesn't work. 6 divided by 0.72 is 8.33, which would be the answer. But it's going to be the basis, not the nominal, because you're not earning the nominal, you're earning the basis. So you'd want a 9.72% bond to equal what you're doing. Because remember, if you're on a 7 basis, you're earning 7. So you need this to equal it. Boom, there it is. So you're going to do again. If they want a taxable yield, you do the muni divided by 100 minus. If they give you the corporate and they want a muni, you have to multiply times 100 minus the tax bracket. I love it. A customer is short April 45 calls and short April 45 puts. Now, I'll write it out, but if you're short calls, and short puts, that looks like a short straddle to me. And short straddle stability, baby. If it's long, I want volatility. If it's short, I want stability. I'm going to go with C as in cat, C as in cookie. So neutral, baby. Short straddle stability. Okay. 100% par, 8% preferred stock converts into 2 shares of common, and the preferred is callable at 105. The current market price of the preferred is 104. The market value of the common is 52. If the company calls the preferred, the client, what should they advise them to do? What should they do? Convert and sell the preferred in the market, tender the call, hold, stand and deliver. So no, let's go through it. By the way, D is never an answer. If they call the bond or the preferred, there is no such thing as holding on to it. You got to give it up. Give it up, baby. Give it up. Give it up. Give it away. Give it away. Give it away now. Okay. First thing we do is par divided by the convertible price to get the ratio. But they did it already. Remember, you're either if they give you the convertible price, you are going to do par divided by the convertible price. But if they tell you the shares, they did the thing for you. So we're going to get 2 shares of common for every preferred we have. And each common is worth $52. So we're going to do 2 times 52. That equals 104. So if I convert, I get 104. But if I sell it, I get 104. That sucks. So it's the same, kissing your sister, baby. But they call it, I can get 105. So that's going to be the answer. I will tender to the call because they pay me 105. Now let's try something. What if I did this? Change this to 55. What would I do? 2 times 55. 2 times 55 is 110. That would be worth more than the other 2, so I would convert. That's all I did. Let me bring it. It was. Deal. A customer opened an account at a broker-dealer with a conservative growth and aggressive income, with conservative growth and aggressive income and has blue chips plus bonds, T-bonds and high yields, has realized modest returns but wants to increase returns, but stay within the level of risk within objectives. That's what that means. What should the RR suggest? Sell the portfolio blue chips and buy the microcap, sell the risky high yield to use the proceeds to buy more treasuries, open a margin account to have more significant return, sell his treasuries to buy stocks with a higher dividend yield. Okay. So they want to increase the return. The only way to increase return is to increase risk. So we have to increase risk. So it's going to be, so B is no good because that's less risk. Open a margin account is never an answer for income because the interest rate you're paying on the margin is fucking ridiculous. So it's too high. So it's either sell the portfolio and buy micro caps, which is fucking nuts. That's crazy shit. They're not conservative at all. So I'm going to sell the treasuries and buy stocks with higher dividend yields. That's still sort of safe. Microcaps are like the smallest of companies, super risky. That's not acceptable to our customer. Remember, do what they should do, not what you think. Well, just do what you're supposed to do. I was trying to think of a good saying, but it doesn't work. What does it mean if a client had been assigned? Her bonds have been called. She's been exercised on an option position. C, her account has been flagged for suspicious activity. I like that one. D, her account is in process of transfer to another firm. No, it's B. If you exercise your option, the person who sold it gets assigned the obligations. Or again, if you buy a put, you have the right to sell. The seller of the put has to buy the stock from you at the strike. If you buy a call, you exercise, you're going to buy the stock. That means the seller of the call has to sell it to you. So the answer is B as in boy. Okay, good stuff. At the opening of the account, you have received the customer's name, social security number, date of birth. What else is required to satisfy anti-money laundering rules? Physical address, occupation, income, investment objectives. We all know this. It's the address. You need the name, address, social security number, and are they 18? So boom, the answer is physical address. We're onward. Okay. We're getting near the end. I might add a bonus. Let's see if you guys want me to do a bonus or not. Okay. Customer owns 10 million of OID, originals with discount, of a new muni offering at 90. If she holds to maturity, which of the following amounts will be reported for tax purposes? Zippo, 10, 90, or $100. Now, here's the thing. OID, you must accrete, that's fine, but it's a muni, and that discount is considered interest. So in reality, you think, okay, if I could think, oh, it's $100, right? But it's not 100 because 90 out of a 10 million is not nearly $100. The answer is 0 because it's not taxable. Now, if you bought a secondary market discount, yes, if you're accreted, you would have to pay capital gains or ordinary income on that. But this is not the case. If you hold to maturity, you're going to pay no taxes because it's a muni and the interest is considered tax-free. Good. When a new customer opens an account, the customer has to duplicate statements gets sent to the investment advisor. What does the RR do? Note it in the account. Send the request to purchase and sales. This is prohibited. Send on a trade-by-trade basis. I would go with, I'm torn between A and B because technically purchase and sale could do this, but no, it's just noted in the account and make sure it gets done. That's all. Just click it out. You got to do it. I look, if you guys disagree with me and think it's B, let me know and let me know why, and I will happily say I'm wrong, but I don't think I am. But, I don't get hundreds on these. I get 99s. Okay. This could be the one I get wrong. So I go with noted in the account so we know. And you want the request in writing, but I don't think you have to send the request to purchase and sales. You just fucking do it. Okay. Which of the following is true about a variable annuity? I could have written it up, but I'm lazy. A, withdrawal is not permitted during the accumulation. B, annuity value remains fixed. Option to reinvest withdrawals received from annuities tax deferred. The performance of the investment in the separate account determines the amount of the annuity payment. Okay, here we go. The answer is D as in David. Because look, you can take money out, you just pay a penalty. The annuity value it goes up and down because it's a variable, and you don't have the option to withdraw withdrawals. You can't, first of all, you don't withdraw. It just goes on top of each other. But if you withdraw it, you're going to have to put it in and pay taxes, and then it'll grow tax deferred, but that's not a thing. So the answer is D as in David. A retail customer buys 100 ABC shares annually for 3 years, paying 10, 12, and 20 respectively. Deciding to sell 100 shares. Hold on, let me change it up. And then deciding to sell 100 shares. Boom. If the customer doesn't determine the method, what do we do? Remember, if you're selling shares, you can do select a share. You can choose your way as long as you do it before settlement, okay? Which is T+1. Like you can leave standing instructions. But if you don't mention a method, the IRS automatically does FIFO because they know that's most likely the lowest cost basis to pay the most tax. So if you don't choose a method, when you sell the shares at 25, you're going to sell the shares you bought at 10 because that's what the IRS does. Now, if you choose your own, you do 20, so you pay taxes on 5. But since you don't mention method, it's $10. There it is. Okay, good stuff. In illustrations of variable annuities showing assumed interest returns, so if you want to show assumed interest returns, remember, this is like that other thing. I can't make projections, but I can show assumed interest returns like variable stuff, okay? What is a maximum gross rate that it can be? 12%. Now, remember, if you show any return at all, you also have to show 0. Remember that. If you show any return at all, you have to show 0. But if the most you could ever show as hypothetical is going to be 12. Let's clean this up. Not that it matters because you're going to see it bad anyway. Okay, here we go. Ooh, that's small. Okay, let me make this bigger. Said every woman to me ever. Okay. And customers that sell 250,000 shares restricted stocks. Now remember, pay attention on this. I'm warning you that it's a tricky one. A customer has held 250,000 restricted shares of company ABC for 13 months. That takes away the holding period problem. Because remember, if a Reg D or restricted, if it's not reporting to the SEC, the financials, it's a year hold. If it is reporting, it's a 6-month hold. ABC, they do the 13 months, so it doesn't become an issue. Now, ABC currently has 20 million shares outstanding, and its weekly average for the 4 previous weeks is 220,000 shares. Under the SEC 144 rule, what is the maximum number of shares that are permitted to be sold? Here's the thing. And I think this is a shitty question. If I did the math, I go, okay, 1%, I would do 222,000, or 220,000 is the average of the 4 weeks. And then I go, okay, 200,000 is 1%. So you think, oh, so it should be 220. But here's the thing. It's just a fucking customer. There's no rule on them. You're just a customer. They don't own more than 10%. They're not a 5% owner, blah, blah, blah. They're not a partner, officer, director. Try a customer, they can sell 250. It's a shitty-ass fucking question, but I'm mean for doing it. So remember that if you don't see that it's a partner, officer, director, or a big shareholder, which is more than 10% or more, don't worry about the 144. It doesn't apply. So that's a tricky question. Now, I did the math so you know how to do it, because I look at the 1% of the outstanding, which is 20 million, which is 200 grand, or the average 4 weeks trading volume is 220. I would normally pick this, but since a person's on a pod, you do the 250. They can say whatever they want. Okay, next. A customer is interested in an investment that will provide an income stream and diversify her current portfolio, which consists of small and mid-cap stocks. The customer has an aggressive risk tolerance at a 30-year time frame horizon and is comfortable paying taxes on the income generated by the investment. Which of the following investments is most appropriate? Okay. T-bills, variable annuity, emerging market, REIT. Those are the 4 choices. So we can throw out T-bills because, hell, they don't pay. We're going to throw that out. Variable annuity pays later. I didn't say they want later, so we throw that out. People are thinking that one. C, emerging markets. That's like fucking crappy companies and countries, so no. Or not up and coming, so they don't really pay dividends. So the answer is REIT. You go, oh, it's aggressive, but it pays income. Remember, I have the holy trinity of suitability. If you see the word income, you must address it. If you see the growth, you must address it. If you see this safety, you must address it, okay? It's a thing. So A, B, and C don't work. REIT is the only one that pays income and is somewhat aggressive over a long time horizon because you're buying real estate, and they pay. Okay. I think this is the last one, but I'm going to add one more just to be nice. Okay, here we go. Customer owns 1,000 shares of the company ABC. ABC has 10 million shares outstanding and plans to issue another 2 million. The customer received rights he's entitled to, which is she's going to get 1,000 rights, which are exercisable 10% below the closing price of 24 on April 13th. What will it cost a customer to exercise 1,000 rights? So remember, your 1,000 rights, you're not getting 1,000 shares. You're going to get less. So we go back to the same thing. We do the numbers game. How many are we going to get? First of all, this is the easy one, 10% below 24. That's 240. So that means whatever I buy, I'm paying 2160. That's 10% below 24. That you should be able to get. Now, the question is, how many shares do I get? So I do 2 million divided by 10 million. That's 20%. 20% of 1,000 is 200. I have this question in my challenging questions. So I'm going to 200 shares at 2160. That's 4320. There it is. Now I'll go it again. I issued a new 2 million out of 10 million outstanding. That's 20%. And remember, preemptive rights allow you to keep your percentage ownership, not increase it. So if you have 1,000, you're going to add 20% to that, which is 200. Doesn't matter how many rights you have. You'd have to, in this case, you'd have to hand in 5 rights to get a new share, which is back to the 200. How did I get that? I would do the 10 divided by 2. I would do what we had divided by what we issue. That number tells you how many rights you have to hand in case they ask that question. Now, and then what do I do this one? It's going to be exercisable at 10% below 24. 10% of 24 is $2.40. 24 minus 240 is 2160, and there we go. Let me see what kind of question I can throw in for one more. Hold on. I'll be back. You won't notice. Okay, so I decided to add 2 more. So this is a fun one. Please pause and try to do this. So I'm going to work through it. As of October month end, which is October 31st, Halloween, a customer's account has the following positions. Long 200, XYZ common, long 1 share, 1 call, and long 2 puts. Okay, so I'm long 1 call, long 2 puts. It's a little weird position. The next day, I enter the following order. Sell 200 at the market. I now no longer have the shares. We agree on that. Then, remember, and then I bought 1 call, which means I owned 1 call. I bought 1, so now I have 2. So now I'm long 2 calls and long 2 puts. And they're same strike and same month. That sounds a lot like a straddle. There we go. It looks harder than it is. Okay. So again, I own the shares. I sold the shares. I don't have them anymore. I long 1, long 2. I added 1 more. I own 2. That's it. I own 2 calls, 2 puts. That's a straddle. Boom. Now, Federal Reserve policy has created an environment of historically low rates, which is basically 2010 to 2020. Which of the following strategies serves as a hedge for customers who are concerned that the Federal Reserve will end its accommodating? Accommodating means that we're making it easy to live, okay? Low rates. Ending it means we're going to raise it. So we're going to invest in treasury bonds to avoid credit risk. That's a thing, but it doesn't answer the question. Investing in floating rate bonds to avoid market risk. Okay, we'll come back to that maybe. Investing in longer duration bonds to maximize current return. Maybe because they have more volatility. Investing in fixed rate preferred securities to enhance current return. Okay, maybe, but let's go through each one. But they don't answer the question. That's the thing. 3 of them don't answer the question. 1, true, but doesn't answer the question. D, remember, when they're lowering when they're getting rid of accommodating, rates are going up. So long-term bonds will go down. That sucks, okay? Because they'll go down because the rates are going up, and this doesn't look good. Same with this one, because if rates go up, prices go down. Both I'd lose money on these, and I'd be buying these low-rate bonds and preferreds, and rates are going up. So I will buy the floating rate, because the floating rate means that the rate will follow along with current rates and move up, 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 and up, and that would work. So the answer is B as in boy. I love it. I may try to do one. Let me see if I can do one more. I'm in a good mood. Okay, here's a bonus. Let me sort it so it doesn't confuse anyone. There we go. Get rid of it. There we go. Here we go. This should be an easy one to end. I'm putting a good mood. A customer wants to buy 100 shares of XYZ, but does not want to pay more than $20. The current inside quote for XYZ is $21.25, $21.50. Which of the following orders should the register rep enter to accommodate the customer? Okay, so what do we do? So if I remember slobs over bliss, this is an easy way to knock some shit out. First of all, fill or kill is very rarely going to be the answer. Slobs over bliss. Now that means sell limits and buy stops to place above the market, buy limits and sell stops to place below. So they want to buy it at 20 when the market's 21.25. So anything with sell limit is out, okay? So buy stop is above, so that's out. Fill or kill is never an answer. And they don't say immediate or cancel. They say this. We're going to throw that out. It has to be a buy limit. But look, it's below. It's below. if I want to buy stock and I may pay more than 20, that's literally a buy limit. I want to buy 100 shares of 20. I do not want to pay more than that. That's the answer. Buy limit. Okay, guys. I think that was a good one. That was a long one. I don't know how long it is. I don't like long videos. You notice I'm wearing different clothes because it took me a few days because I didn't have time. I'm teaching so much. Guys, don't forget, I have I'll talk a little bit. I have every Tuesday night at 8 p.m., I do a live Q&A just on SAN 7. I split it up between that and the 60, 65, and 66s on Thursdays so that you don't get distracted by shit that doesn't matter to you, right? So if you do if you're worried about, you're going on to answer a question about preemptive rights, you don't have to listen to investment advisors and consent to surface of process and stuff like that. And it helps the 65 people. They can go where they hear with their own shit. So again, 8 p.m. Eastern, and we're going to try something new in the next couple of weeks where we do a part of it, maybe start earlier or later, I'm not sure which, where we don't talk about product, we just talk about how to take the test and like test taking stuff, like how to register for the SIE, stuff like that, like housekeeping stuff, not testing. Then at 8 o'clock, we'll do the regular stuff. Okay. I love this. If you like what I'm doing, hit like, subscribe, and share. Please tell me if you disagree with any of my answers. Tell me if it helps you or not. Tell me if you learned something out of this. Give me feedback. Be brutal. Be nice. I cry a lot. Just let's get this. Let's fucking go, people. I want everyone to pass, and I want this to be the game where it goes. Everyone, you all have a good night. Stay classy. Ciao.